All right. Let's get this going then here. Okay, so we own the December 6th, 85.5, 87 call spread, of which we paid 40 cents. Okay, with the stock right here at 85, our spread is trading 45 cents. Okay, so stock is now 85 and our spread is 45 cents. So what do we do here? You know, how do we measure where the profitability is going to be, where the risk is, how much premium is going to potentially come out with the holiday, extra day off, and this, that, and the other. You know, we definitely have to monitor all of that. So how do we really do that? We know that, you know, if by the end of next week, the stock is here or anywhere below 85.5, the spread is going to 0, right? So there's going to be that 45 cents worth of theta, because right now everything is all extrinsic value. It's all premium, right? Everybody follow along and understand that? Okay, so if we look at just the move based off of delta, what is the delta of our spread? Yep, keeps fluctuating here, but yeah, let's call it 25. Okay. Okay, which means for every dollar the stock moves, the value of the spread should change by a quarter. Okay, now here is one of those teaching lessons and kind of one of those characteristics about options and delta and premium as you get closer to expiration. Okay, so let's say, okay, and this is just hypothetical here, let's say the stock rallies $1 from here next Friday, okay, at expiration. Based on the value of where it's trading now and what the delta is, what would the value of our spread be if the stock were trading 86, so $1 higher, next Friday at expiration? Okay, Tom, you've got it. 70 cents, right? Just 45 right now plus 25, it would be worth 70 cents. However, and Bill, you got it, you know, you're going to the next step. At expiration, with no premium left, the spread would actually be 50 cents. So you can see here how when you're long premium and you get closer and closer to expiration, and listen, we're still 9 days away, okay, but you know, I want to put this out there so we can be forward thinking about this. The closer and closer you get to expiration, the more that theta starts to kick in. So if we let this go all the way to next Friday and the stock just went to 86, rather than the spread being worth 70 cents, it would actually only be worth 50 cents. Everybody see that? Okay. Now, let's say, though, that the move is over the next day or two where, the premium decay, the theta, is not going to be as significant. Then we can look at this more of, okay, as a delta move, what is the value of the change in our spread going to be? So if the stock moves up $1 today or this Friday, the pure delta will be more reflective of the value of the change in value, I should say, of the position. So if we were to go up to 86 today, yeah, this thing would be trading 70 cents. If we were to go up to 86 on Friday, probably close to 70 cents. But if we don't get there by the end of this week, and now you have to kind of factor in decay, theta premium decay over the weekend, come back Monday, now it's going to really start, kind of settling in a little bit. Okay, so on our spread here, if we looked for our typical 70%, okay, we would look for a 68-cent exit. Not out of the realm of possibility. I mean, if the stock rallies today nicely, we could get there. It's probably not probable, but again, we're looking ahead so we know how to react, so we can be proactive instead of reactive. Okay, so that's kind of our ballpark here of where we might look to exit today or Friday. Again, as we get closer and closer to expiration, if we hold this to next week, we may then start adjusting where we want to take some profits, because now we're really fighting some headwinds against decay and theta. Everybody understand that concept? Okay, now, I think it would be very prudent at this point to also put out a stop in case the market turns around today, in case StarBucks turns around today. I don't want to put out a 40-cent stop, which was at our entry point, because that's a little too tight. But again, my rule of thumb typically is to go about 15 to 20% below the bid in the market. Okay, so, given that right here, that would be kind of tight at 35 cents. But that wouldn't necessarily be a bad thing. I'm actually thinking about a 30-cent stop right now, which we can then, adjust. Hopefully we get to keep adjusting and adjusting and adjusting like we did with our Baidu position. I'd love to put out 5 different updates to a stop exit today. And yes, Tony, decay and theta are one and the same. Theta is the premium decay. Yep, time decay. Exactly. Exactly. And right now, again, and the stock has rallied a little bit. We're at 85.14 now, and the spread's trading 47 cents. But if we were at 85.14 next Friday at expiration, then all of this would be decay, right? All of it would be premium. All of it would be theta because the options are out of the money. Okay, so yeah, time is theta, right? You got to remember, guys. Options. One of the first thing that I learned literally when I walked on the trading floor my first day as a clerk back in 1990 was options are a wasting asset. Options are like when you go into the showroom and buy a car. The second you make that transaction, the car is already worth less, right? And that's how it is with options. Options are a wasting asset. That does not mean that you don't ever want to buy them because that decay is priced in. Okay. With Spotify, Dean, yeah, we're fighting against that also. But I'm not going to put an exit out there in spot because there's way too much upside for the amount left in the downside. So I'm not going to put that out there. Okay. Any questions about Starbucks? And we will keep, looking at this real closely here. I remember, I think it was last week, if I'm not mistaken, a couple students were like, God, we got to get out, we got to get out, we got to get out. Right? Because, the stock was down a few pennies from where we had bought it. What do you mean, how did I get to 50, Connie? Right, Julie? I posted it all over my Twitter account. I posted it everywhere. I said, go buy these turkey sandwiches from Starbucks. Connie, wait. Okay, so Connie, if we go back to the whiteboard here, okay, if we're at expiration and the stock is 86, what's the value of our 85 and a half call? No, the 85 and a half call, Connie. Okay, 50 cents. What's the value of the 87 call? Okay, so there's your answer. Does that make sense? right? Does that make sense? Okay, cool. All right, any other questions on this analysis? And here's what I'm going to do, guys. I'm going to put out 2 exit signals right now in StarBucks. One is going to be a stop exit. One is going to be a partial exit. Okay, stop exit will be at 35 cents. The partial exit will be at 60 cents. I know 68 is our target. Okay, but again, I'm a little bit concerned about fighting premium with the day off tomorrow, holiday, and then the weekend coming up. I'd rather take partial profits off the table a little bit and then let the balance run if we get there. It definitely is banging right up against that 50-day moving average, Glenn, which you can all see right here. Okay, any questions, guys? My pleasure, Daniel. My pleasure. All right, let me get the wait, so the stop is for the remainder of position. Well, no, Ken, the stop is going to be for the entire position, right? Because we don't know if we're getting filled on that partial. So the stop is for the whole position, and then there will be a partial exit or half. I'm a ventriloquist, Dean. Tony, yes, you can. It is because I'm actually working remotely, so that's why it sounds a little different. Right? Nice one, Robert. All right, guys, let me get this out there, the whiteboard and the video, and then I'll get those signals out, and I'll be right back.